Hi, this is Pragati. Let's try and understand exchange rates and what do they mean for the export competitiveness of the country. I will simplify all these technical words for you over the next 5 minutes, but before that, please like, share and press the bell icon below. Imagine you are a YouTuber, creating awesome content in English and uploading it for viewers worldwide. While you have fans from all over, most of your subscribers are from the US. Now, here's where the exchange rate story begins. You earn your YouTube dollars through ad revenue, and this is where exchange rate comes into play. Every time someone watches one of your ads, you earn a certain amount of US dollars. But the exchange rate decides how many Indian rupees you'll get for each US dollar. So say if the exchange rate is 1 USD is equal to 80 INR, you would get 80 Indian rupees for every US dollar earned from YouTube. So this is simple, right? But wait, there's a twist. Now when the rupee weakens, you will get more Indian rupees for every US dollar. But if the rupee strengthens, you get fewer Indian rupees for the same US dollar. A weak rupee means you're rolling in rupees, while a strong rupee might make you feel like you're earning pocket change. So it's not just YouTubers. The role of exchange rate in our life goes beyond that. They influence the prices of imported and exported goods, but they also affect the value of our investments and savings. When exchange rates fluctuate, it can either boost or dent the value of your investments. Say for instance, if you've invested in international stocks or bonds, changes in exchange rates can influence the returns you get. A strong rupee can make your foreign investments seem less lucrative, while a weaker rupee can make them look more attractive. Moreover, if you have plans to travel or study abroad, the exchange rate matters there too. A favorable exchange rate can make your overseas adventures more budget friendly. For example, if the rupee is strong and the exchange rate is favorable, it means you'll have to spend less in INR against every US dollar. This can make your vacation or international education feel more cost effective as you'll have more spending power in the foreign country. However, when the rupee is weaker, it might require you to spend more in Indian rupees for every US dollar, potentially making your overseas plans a bit pricier. Consider this. An Indian company exporting textiles to the US needs to know how many rupees they'll get for each dollar. If the rupee is as unpredictable as, say, the stock markets, it's hard for the company to predict its earnings. So while we're talking about the volatility of the exchange rate, I will try and add a pinch of history to add greater substance to the understanding. India has had its fair share of exchange rate adventures. Picture it. A few decades back, we used to have a fixed exchange rate regime. Predictable but not flexible. Meaning, if say our currency is pegged to USD at 1 USD is equal to 10 INR, the central bank will alter the policy and reserves to maintain that exchange rate, which is kind of similar to what we have for inflation, that is the inflation targeting. But times changed and India shifted to a managed floating rate regime. This shift allowed the rupee to fluctuate, but the fluctuations are never too extreme because of intervention of the RBI. The managed floating exchange rate regime means that the exchange rate is determined by the market forces of demand and supply. But say in a scenario of excess demand of USD, the value of INR would not fall from say 83 to 90 in a day. The managed floating exchange rate is to curb exactly that. In a scenario of extreme volatility, the central bank steps in to protect the currency from excessively appreciating or depreciating, like it did in the 2008 global financial crisis by the sale of foreign exchange reserves. Therefore, the managed floating exchange rate regime has made Indian exports more dynamic and competitive. When the rupee weakens, Indian goods and services become cheaper for foreign buyers. It's like a sale for the importers abroad, and thus a boost in the demand for Indian exports. So in a nutshell, exchange rates are a big deal. They can influence our lives, both personally and professionally. Understanding how they work and their impact is essential. So I'd like to conclude it with an analogy. Imagine you're a kid who's selling lemonade at a lemonade stand. You want to make as much money as possible, so you need to set the price of your lemonade just right. If you set the price too high, people won't buy your lemonade. If you set the price too low, you won't make much money. Exchange rates are like the price of your lemonade. If the exchange rate is too high, it will make Indian exports more expensive for foreign buyers. If the exchange rate is too low, it will make Indian exports more competitive for foreign buyers. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.